Trusts and insurance are both useful tools in your succession planning toolbox. Unfortunately, they are sometimes underutilized and misunderstood. Let's begin with trusts.
People are confused by what a trust is. And they think of them as, as a lot of things that they aren't. Some vehicle to hold big assets, and they're expensive to do. That's what they think. And that there's some sort of thing that's irreversible, and they aren't necessarily. In the case of succession planning, trusts can be used to hold assets during an individual's lifetime that are completely revocable, meaning you could take the asset back out, but which assure at your death that the assets will go to the right place.
Trusts can also be helpful in avoiding probate.
A business owner wants to set up a trust to make sure that the business is taken care of during either their disability or upon their passing. It's an easy way to make sure, without court involvement, that the business is handled appropriately.
The business owner might say, what's wrong with probate? Isn't that a good thing, because now there will be an accounting of all my assets? Well, the answer to that is no, because most business owners and individuals don't like to have the world know what assets they own. So if you do nothing with your estate plan except to have a will, all of your assets will go through probate, and the world will know what assets your estate owns.
A trust is a contract between the grantor, the person who sets it up, and a trustee, the person who is chosen, or the institution that's chosen, a bank or a trust company, to manage the assets that are held in the trust and to carry out the terms of the trust. So it is a private contract.
One of the issues that often makes succession planning difficult is the large number of options that are available. Trusts are no exception. Decisions on which trust to utilize should be made in consultation with your advisors and be designed as tools to meet your goals.
With the various trusts, you want to consider what your goals and objectives are. So for example, if your goal and objective is to provide for a charitable bequest and you've taken care of your family through other means, then a charitable remainder trust may be a good avenue. If you're looking at preserving value and you're concerned about highly appreciation, then a GRAT would be considered. If you're not concerned with the value necessarily growing and you want to provide as much flexibility as possible, then just a regular revocable trust may meet your needs. If you're looking at some current income tax issues, then a defective grantor trust may be appropriate.
The basic thing would be a typical what we call AB marital exemption equivalent trust. And what happens with that particular vehicle, if you, the owner, die prematurely, your business enterprise will be owned by that trust. And the first $2 million today, $3.5 million in 2009, will be allocated to the family trust at a tax-exempt basis, free of gift and estate tax. And any amount of value beyond that $2 million and someday $3.5 million will be allocated to the marital deduction trust, assuming you have a surviving spouse. Therefore, you can assure your family as a business owner with that AB trust as the basic building block, there will be no tax at the first spouse's death. So you've got all this time then to theoretically plan for other transactions. So once that's in place, the business owner at least is free to know that if I die prematurely, that's taken care of.
The intentionally defective grantor trust, or as I commonly refer to it as an IDGIT, is one type of trust that is used to do an estate freeze. And by an estate freeze, what I mean is we're locking in the value of the business so that at some point in time, we will know what that business is worth. And if something happens upon that time when we involve the intentionally defective grantor trust, the value will be locked there so that the individual will only have to pay estate tax based on the value of the asset in the IDGIT.
A life insurance trust can be used to provide for family members that are not involved in the business, or if you're going to sell your company to employees or management at a reduced value, then a life insurance trust can be used to replace that value given up for your family. And a life insurance trust set up appropriately would be an irrevocable trust to hold the life insurance. And the reason why it's set up that way is if you establish it as a trust to begin with, it is exempt from federal estate tax. If it's a current life insurance policy that you own and you transfer it into a life insurance trust, you need to live 3 years and then it would be exempt from estate tax.
I will have life insurance that's going to be paid at the time of my death into a vehicle that's irrevocable, and because it's irrevocable, that life insurance is not added to my estate for tax purposes, but the cash is available to pay my taxes so that the family does not have to sell the business to pay my taxes. They have the cash inside the irrevocable trust to pay the taxes.
Insurance in general, and life insurance in particular, can be used to augment your succession and estate plans. Unfortunately, many people mistakenly believe that insurance is a substitute for proper succession planning.
Life insurance is a very important tool used in business succession to protect the value of your assets, to create liquidity at death, and also to move wealth to family members to equalize the estate. However, life insurance is just a mechanism of creating wealth. It does not create a succession plan.
So if we have a valuable business that is going to be part of the estate, and an individual wants to try to pay for that estate tax, we can do it through life insurance. Another important use for life insurance in the business succession plan context is how am I going to buy out that individual shareholder upon his or her death? And life insurance is a valuable tool that we can use in order to transfer that wealth from one generation to the next.
Insurance can also be used in the succession plan not only for your own personal life and family planning, but also if there is a buy-sell agreement, which you would commonly have with multiple owners within the business. Life insurance can help fund the buy-sell.
Buy-sell agreements are an instrument in business succession planning and deal with a variety of what-ifs. They define how shares are transferred under as many possible scenarios as you can describe and as you can think of. Death, disability, retirement, divorce, termination of employment, voluntary, involuntary termination of employment, termination of employment for cause. And so they not only define how it transfers, when it transfers, it defines who it can transfer to, so it generally restricts shares. And a big purpose of it is so shares can't go drifting out to anybody.
Also, if you're selling your business to an outsider or to management and you're not receiving cash, but you're receiving payment over time, then you will want life insurance on those folks that have taken over your business to help secure your payment for the business.
There are some issues to remember when thinking insurance.
We come across a lot of business owners who have life insurance. They've done a good job of purchasing life insurance. They have a bunch of it. They own it themselves, or it's in their business. Big mistake. Big mistake. The value of the insurance is in your estate. At the date of your death, it's income tax-free. That's the confusion. A lot of people think that it's tax-free. It's income tax-free. It is not estate tax-free. So what you bought to deal with illiquidity problems and sometimes to pay tax just compounds the problem.
Insurance will take care of the taxes at the time of your death. It won't take care of the issues dealing with who's going to make the business decisions regarding your business, who's going to run your business, who's going to determine how the salaries are paid among your children, and who's going to determine the resolution of acrimony among the family members. It is a piece of a succession plan. It is not a solution. It is a piece.